management, debt capital markets, and then originations. And then I was at Wells Fargo for a few years. So I have worked actively in the financing world in various different parts of corporate finance for better part of 16, 17 years. And after that, I left Wells Fargo and I started CAPX, because during my time when I was at various financial institutions, I realized that it is really difficult for middle market companies to really find multiple options to raise capital, especially in the debt world. It's a very manual process, and technology could improve that. And that's what we did with CAPX. So CAPX is a platform that connects companies that need more than $5 million in debt capital with multiple lenders across the country, bank as well as non-bank lenders. We have about 100 different lenders on our platform, banks and non-bank lenders, from very large institutions to small funds. We have done over $1.5 billion in transactions. Smallest transaction, 15 million, the largest, 325 million. We'll talk about one of those here, or a couple of them here. And we work with independent companies like you guys, as well as private equity firms and independent sponsors. So I like to say, kind of in a funny way, that we are basically Bumble for corporate finance. And so that's what we are trying to do. When I started working with TMA, one of the first things that came to my mind was some of the recent transactions we had done and kind of difficulty those borrowers had in getting capital and how we solved the problem. And one of the issues that I've repeatedly seen in private or family-owned companies is at times their contacts are limited to banks that are calling on them. And when these banks are unable to give them the capital they're looking for, they don't have many options, and they often end up raising, minority equity, so sell, part of the company to raise the capital they need to expand company or make acquisitions, etc. And I've seen this again and again, that when they end up raising equity, really the company could raise debt from the private debt world, which has become very robust over the last 15 years. And they can obtain much better, much more cost efficient and flexible solution versus, selling part of the company. So I just wanted to, walk through 3 cases today where we can focus on how to monetize the equity you already have without really selling it. So that's an important part of the process. Secondly, if you are trying to monetize the company, what is kind of the most efficient way of doing this? And that's combining the classic bank financing with non-bank options. So your cost would be a little bit higher, but still you get maximum amount of capital you can. And 3, this has been going on for a while now. There's a lot of talk about, baby boomers retiring, or, companies trying to sell. But with the macroeconomic situation, entrepreneurs are not always ready to sell. They are not seeing the right environment for it. So then how you can take some chips off the table, basically doing a little dividend recap, where you don't take all the money out, but you can take some money off the table and kind of wait for a little better time in the cycle to sell the company. So I can walk through all these 3 scenarios and 3 cases for you. Before I jump into this, I think we didn't announce, but I'm very casual about this. If you have any questions, you can unmute and start talking and stop me. Or if you just wanted to submit a question through chat, then we can do that as well. Or you can ask at the end. Either way, any of these options work. So I'll start getting into this. So the first case I want to talk about is, this was a business service company. They basically were in revenue cycle management. It's owned by an entrepreneur here in California, a relatively small company, about 20 million EBITDA, about 4 million, 20 million revenues, about 4 million EBITDA. And they wanted to, the entrepreneur, very dynamic individual, and they're kind of determined to grow the platform through acquiring multiple smaller mom and pop type of organizations and kind of roll this up at a very large national scale. Obviously, they needed capital to do that. And they had identified 2 acquisitions that they wanted to make. And both of them are a lot of numbers here. I apologize, but I'll walk you through all of them. The first acquisition was really interesting, about 30 million revenues, but very large EBITDA. And it was a really unique situation. But because the EBITDA margin was so high, the enterprise value or the purchase price was very high as well. And the second acquisition was a small tuck-in, not very large amount, but combined, they needed, low 40s, mid 40s in capital in order to make this acquisition. And the entrepreneur was not in a position to put large amount of capital in themselves. So the challenge was, they did not have much equity to put in. So they had to really get all the capital from somebody else. Secondly, they are really small compared to the targets they're buying. So when you go to a bank, typically they would look at that and say, well, you're 4 million in EBITDA and you're trying to buy a company that is, 3 times your size. You'll have, integration issues, and we don't want to do this. So a lot of banks would have that type of feedback. Um, and then the interesting issue was the first acquisition, while such high EBITDA, all their revenues were coming from abroad. While the company was in the US, all their customers were abroad. So that ended up creating a massive issue for a lot of banks that the company had approached. Um, and unfortunately, the acquirer or the entrepreneur that we were working with, they had never done this type of structure, which is pretty common when you start dealing with smaller companies. They would not have done 40, 50, $100 million transaction before. So this was completely new for them. So the only way they could get financing was people they knew. I mean, their bank was JP Morgan. So they went to JP Morgan and said, hey, can you give us 40 million? And JP Morgan said no. Then the other option they had was to raise equity. They already had a minority equity investor in the company, and they had sold 25% of the company and raised $12 million for that. And this happened a couple of years before they came to us. So they went back to the same minority owner and showed them this opportunity and said, hey, can you give us $40 million? And it was a pretty attractive opportunity because post acquisition, the EBITDA was going to be 17 million. And that gives you, once you go above, $15 million, it gives you an increase in the multiple. So it was going to be, 150, $170 million enterprise value. So equity guys were ready to invest, but for additional equity. So had they gotten money from the equity investor, they would have basically given up half their company. So that would be the cost of capital. And there was no guarantee that this same equity investor would allow them or give them capital to buy additional companies. And remember, as I said earlier, very dynamic entrepreneur. They had identified this opportunity to roll up the industry. So they wanted to keep making additional acquisition and get the company above 25 million EBITDA. At that point, there's also an increase in the multiple. So the enterprise value of the company would go up. So if they ended up going to the equity investor, they could probably solve for this particular deals they had with a huge dilution, but there was no way for them to be certain that they would get capital going forward from the same guys, and what would be the cost of that. So at that point, they came to us. We looked at the profile of the company, the leverage, etc., and we told them that while you don't have equity to put in, when you combine these three companies, there's a lot of equity value, as is borne out in the enterprise value of the company on a pro forma basis. And we can leverage that. And we need to go to non-bank lenders who will do this transaction, but banks would not. So first, we approached a group of non-bank lenders, and we quickly found traction with them, and we found multiple term sheets, 80 million to 85 million type of total financing package, which would have allowed them to obviously complete these acquisitions. But not only that, it would have allowed them to repurchase this minority equity for which they had diluted themselves by 25%, pay for transaction expenses, and have a delayed draw term loan of $20 million, which would allow them to make additional acquisitions over the next 18 months. So this was kind of ticking all the boxes for them. The negative side was that this was not cheap debt. It was SOFR 10%. So it was expensive. And then while they were buying back the minority equity, which was 25% of the company, they would still be giving some equity warrants to this lender. So they would be giving 5% warrants to this company. So net, it was positive. They were buying back 25% of equity at par, which was the arrangement with the minority owner. And instead, they're giving 5% equity to the lender. So basically, now they're saving 20% of the equity. And the price would be so for 10%. So high coupon, high degree of debt service going forward. So what we did was after this non-bank lender was on board, we went to certain banks and we tried to bring them in as a first out lender. So they would come in, give us 20, $25 million as a first lien, first out. And the non-bank lender will become first lien, last out. And by doing so, bringing the bank capital in here at SOFR 375, on blended basis, we ended up saving a couple of percent on the cost of debt. So then it ended up becoming on a blended basis, SOFR plus 8% or something like that. So it was and at that time, compared to today, this is about, 12, 18 months ago. At that time, this was pretty market transaction for this type of credit quality and, this type of credit concerns. So it was a very successful execution. And here's the comparison of what ended up happening. So when you see on the left side, this is the structure that we ended up bringing in. They funded $48 million plus something in the line of credit. And if you look at the company 5 years down the line, we assume that the EBITDA grows 5% year over year. At the end of 5 years, EBITDA would be about $20 million. And conservative enterprise value multiple for that would be, 10 times. That's about $207 million in enterprise value. And considering the interest rate and what they would be paying on interest and the cost of warrants at that point, the total cost of the debt would be $48 million. I misspoke earlier. They funded about 56 or so at close. So it'd be $48 million funding, a $48 million cost of this debt over a period of 5 years. And the idea was to roll up the company at the end of 5 years, end up selling it. So if they sell it for $207 million, they basically rented capital for 5 years for $48 million. That was kind of the idea. On the other hand, had they taken money from the equity investor and they would have diluted themselves by 50%, the cost of that money would have been $103 million. So that's kind of the first differential you see, that we basically ended up saving them about $55 million compared to doing a debt financing versus getting money from equity. And this is kind of the point. This is why I want to do these webinars and tell people that, it is possible to get debt, although more expensive than bank, but way cheaper than equity to solve some of these problems. And the third bar chart shows the effect of delayed draw term loan. So remember, in the financing we arranged, we provided them with $20 million delayed draw term loan, which would have allowed them to acquire, $6 to $8 million of additional EBITDA by acquiring additional companies. So now, at the end of 5 years, the EBITDA would be about, $27, $28 million, and they would get an increase in the enterprise value multiple, and they'll end up becoming, $400 plus million enterprise without really much equity dilution. With even equity dilution, their cost of capital would be $68 million. And that option was not even available if they had gotten money just from equity. So this is kind of one scenario where we can show tangible proof that you can create these complex structures. I mean, it is a complex structure to bring these bank and non-banks together. There's a lot of legal documentation, complication, multiple parties negotiating. But net, if you want to build something, there's a very cost-efficient way of doing this without diluting yourself. So that's case number one. We'll go to the second case. And this was a private equity transaction. The company is in the industrial products manufacturing space. Large, decent sized company, about, a couple $100 million revenue, about 27 million in EBITDA. And it was being sold at not really high multiple. And the reason for that was The EBITDA was choppy. There were several operational issues. There were multiple manufacturing facilities. It was basically a turnaround situation. It was a working capital intensive business, so they needed working capital line. The EBITDA was going up and down. And the seller that was selling the company, basically, they were not making any money. They were, in fact, taking a little bit of haircut. So when you show something like this to banks, the first thing is, okay, we can do this, but we can do this conservatively. So we'll not give you more than 50% of the purchase price. So that's kind of the first thing. Um, and then they worry about the trends, they worry about the operational turnaround. So banks, the private equity firm did go to a bunch of banks and a couple of them did give them some indications, but it was not a robust outcome. So when they came to us, we looked at this and we said, well, first of all, it's a turnaround situation, but it seems the plan you have and the team that you're going to bring in, we can do this turnaround. So we can go to lenders who can look at this fundamentally and give you value of that. Second, there is a lot of working capital assets here. So we should be able to monetize those assets. Again, similar to the last case, that we should be able to monetize those assets with the bank, get really, really cheap financing. And then let's see if we can find non-bank lenders that can give you capital that you're looking for and give you the right debt capacity compared to what you're getting from the banks. And the third thing they wanted to do, similar to the last case, this industry also had a couple of other players that were attractive acquisition targets. So this private equity firm wanted to build a platform. They wanted to make 2 or 3 additional acquisitions. So they wanted lenders who would have the capacity to keep funding them for additional acquisitions. So they wanted us to help them secure that type of structure. So these are the options they ended up getting. Pardon the graphic, but I try to illustrate what's happening here. The outside circle basically shows the amount of debt that was available from a particular structure, and the dark gray in the middle tells you about the interest that they would end up paying, the debt service on that structure. So the first, they went to a bunch of banks. Some of the banks said, well, we can give you ABL, but based on the current assets, it's no more than 35 million or something like that. They had various plants, but there was not much value in machinery and equipment and the plants. So obviously low interest, but there was not much debt capacity. So it doesn't make an LBO case here if you just get 35 million. They went to some banks who ended up giving them indication for cash flow loan, but again, they were going to limit themselves to no more than 50% of enterprise value at best. And then they would have a pretty steep amortization attached to it. So they could get about 60 million in debt, pay a little bit more interest, but still bank interest. But still, they were not maximizing their debt capacity. So that's this second case. And the third case is they ended up going to some private credit firms, and they're ready to give them capital because this private equity firm was putting in meaningful amount of capital. They're bringing the right team, and this private credit funds were open to taking this risk, so they could get $95 million up to 70% of enterprise value, and they end up paying close to $11 million in interest. So when we got engaged, we said we can blend these two things. So we can get these private equity, private credit funds, and we can connect them, or we bring in some asset-based loan there, because again, manufacturing companies, a lot of inventory, a lot of accounts receivable, it just makes sense to monetize those and get really, really cheap capital. So that's exactly what we did. We got $25 million line of credit at SOFR 150. So it was a really cheap capital. We funded about 7 million in that. And then we got a private debt fund, and we had 5 different options, and we generated these 5 options in 5 days. So we brought in private debt or private credit fund, and they ended up agreeing to fund $86 million. And I think it was at SOFR 650 or 675. So blended, it was a very reasonable cost of capital. They would end up saving, close to $1 million on interest compared to going straight to a private credit fund. So they achieved the maximum amount of monetization that they could get. at a pretty reasonable cost. Plus, both the bank as well as the private credit fund agreed to allow them to raise additional capital from third parties if they are not able to provide capital. So, kind of on a pari passu basis, on add-on, which are really the terms that are available only in the bond market, but we were able to negotiate those for them. So, if they are making additional acquisitions, the first option would be to go to existing lenders and they can fund up to $60 million or $70 million of additional capital to make additional acquisition, which would solve their problem to acquire additional couple of companies. But just in case, if the existing lenders were not able to provide that capital, they agreed that the PE firm could go to the market and bring additional debt on a pari passu basis up to $70 million and make additional acquisitions. So it was, again, pretty good outcome. And here we saved some, interest cost, about $1 million a year plus amortization. But the problem we solved here is we maximized the debt capacity. So we increased the debt capacity by about $30 million or so. So that was the solution here again. And had they not done this, the alternative for the private equity firm was to put in more equity. So again, the bottom line message is the same. In today's market, there's so much diversity in debt capital markets that you can minimize the contribution of equity and you can basically rent debt capital and service that through ongoing operations before you sell the company. And that's exactly what's happening here. The third case I would present, and it's just one page because this is pretty straightforward. It's a dividend recap for a private equity firm. So they had bought a specialty chemical manufacturer, and they had done a couple of add-on acquisitions over 18 months. And now it was a pretty sizable enterprise, about 400 million in revenues, about 100 million in EBITDA. And they went to market and they were talking to multiple parties to see how they can obtain dividend. And obviously dividend was quite possible. This was meaningful enterprise and the markets were quite hot at that time. And all the offers they were getting from various arrangers and the banks, et cetera, was the two gray bars that I'm showing you here. Most of the banks told them that they can arrange capital, they can go to the institutional market and get, about $275 million in dividend and 50 million of additional line of credit. At SOFR 500, pay about 1% for arrangement fee. So about $33 million of ongoing debt service for a couple of years. And then they can also go to private credit funds who can write a big check. Unlike institutional term loan market, they don't have to do credit ratings. They do not have to do a broad syndication. They can just go to 3 private credit funds and they can write a big check and they can get the deal done. A little bit more expensive. So for 7, couple of percent upfront, that would be about $47 million of debt service cost over a couple of years. And I'm saying a couple of years because the idea was once they were taking out the dividend, the company would continue to grow. In a couple of years, the EBITDA would be in mid 100s, and at that point they would end up exiting. So that was the scenario. So that's what we are looking at. And they came to us. We looked at this and we said, you know what? I think we can do this deal with banks because it's $100 million EBITDA company. It's a pretty sustainable business, and we should be able to do this with banks. And we are the only ones that offered this solution. Although they had talked to multiple banks, not a single bank offered them that solution. So we took it to market, and we got the deal oversubscribed. I think we got $400 million of commitments for $325 million deal that we are selling. And it was SOFR plus 300 at 35 basis points in upfront fee. And we brought in 9 different banks, including some of the banks that had come earlier and offered them institutional term loan arrangement or the private credit arrangement. There's a phenomenal execution. And I don't think such a deal was ever done in the debt capital markets where you could have a private equity firm taking out 6 times their equity investment within 18 months of their first investment. So it was absolutely superb outcome for the private equity firm. And combined for 2 years of debt service, and if you compare all the other options, the option that we gave them basically ended up saving them $25 million. Obviously, they could have executed in institutional market and the private credit market. Both have pluses and minuses. But the option that we gave them ended up, solving for $25 million, saving them $25 million. So the takeaway here is, I think to the extent, and this was a really aggressive transaction, and I would not recommend doing something like this for a non-private equity firm today. But where capital markets stand today, as everybody knows, there are macroeconomic challenges in the system today. A lot of lenders want to lend money, but they are not finding the right opportunities. So today, I think many lenders are open to doing dividend recaps for entrepreneur or family-owned companies, and that would not have been the case 3 years ago, but today that's a possibility. I would not say that you take out all your money or majority of the money, but if you wanted to take out some money, kind of take some chips off the table while you wait out the current macroeconomic issues that we are going through, let's say a year down the line, things would be much better, then that's a possibility. And touching on the macroeconomic environment, one of the messages that I think I want to send out is, obviously, there are lots of challenges with the tariff issue for a lot of manufacturers and other services companies, but I think there are lots of opportunities as well. And if somebody's thinking that this tariff environment ends up creating opportunities for them to, create a larger business opportunity, supply their bigger customers more goods, and for that they need to make investments, I think it's important to keep in mind today that you have this very large private debt market that very effectively supplements what you can get from banks. And you can do all types of transactions without really contributing large amounts of equity in executing any of these things. So that's kind of my core message here, that there are many options available in today's market. And if you structure it right, you can create really a cost-efficient transaction. So I'll stop there. If anybody has any questions or comments, happy to address.
Again, if you do have a question, feel free to either unmute yourself or drop it in the chat box. We do appreciate hearing from you all since you are here to hear the information. Rocky, with that, I am going to say thank you. It looks like there are no questions at this time. Please, if you do have oh, I'm sorry. Go ahead.
I'm sorry. Hey, Rocky, question. Are you guys only dealing in $5 million and over?
Typically, that's correct.
Okay. And so essentially you guys are mezz debt, correct?
Not necessarily.
Okay.
As I showed, there are banks that are on our platform, as well as non-bank lenders that provide senior lending. So on our platform, companies can obtain 10 different types of debt structures, starting from asset-based line of credit all the way to mezzanine debt and everything in between. So we are not capital provider ourselves. Our platform ends up connecting borrowers to the lenders.
Okay. Thank you. That was it.
Sure. Well, we can probably provide people my email later on in the communication, and if they had any additional questions, then they can come back to us at that time.
Absolutely. I'll give one last chance. If you do have a question, please feel free to unmute or drop it in the chat. Otherwise, I want to thank Rocky so much for your time this morning, and CAPX for providing this wonderful webinar and information. I know that this is a lot of great information that our members value. So I appreciate your time, Rocky. And everybody else, I hope you have a great rest of your day and the sun shines bright wherever you are today.
Okay. Thank you so much.
Thank you.
Okay. Bye.